All right, so the theme for this month's Speakers Bureau is Set the Record Straight. We're going to take some things that you've heard that are true that really aren't true, and then many of you use these untruths to make decisions about what you're doing. These Speaker Bureaus are very, very important because you need to understand how what we're doing works. We're not guessing, we're not reacting, we're proactive in our manner of doing this. So we've had very good results, but that's not the most critical thing. The critical thing is that you understand how this works. How many people here are afraid of the market correcting?
Oh, that's good.
Okay.
Less than usual.
Alex and I want it to. We want the market to correct because we will make more money when that happens. So any further delay, I'm going to have Alex get us started. We're going to go back and forth and try to get this information in a meaningful way to you. When you have a question, raise your hand and we're glad to get it. Go ahead, Alex.
So I was thinking of the topic, and last time we kind of did myth busting, and I didn't want to repeat that, but one of the things that we often get with new clients and maybe prospective clients is this concept of fees and cost. And so that's something that we wanted to set the record straight with, give you some information about basically how the industry works and how we are operating in a much different sense than the average investment advisor. And then at the end, I want to give a quick refresher because we go over so much information about how our strategy works and risk management. And since Chris Kaufman's going to be here next month, it's important to kind of refresh this information so that when he has his presentation, which is very technical and deep, that you kind of have the preliminary knowledge. So with that being said, this is something I see every single day, is this concept of zero cost investing and these megalodon brokerage houses that are ultra low fees that are just growing substantially. And so this is not going to stop. This is something that's been happening quicker and quicker. But I want to shed a light on some of the risks of having your money at these places. This presentation isn't to bash any company, Vanguard, Fidelity, or whatnot, but it's really to give you guys more information so you can understand why we do what we do. My first question to you guys is, in what business does the best person in that business charge the lowest fee? In baseball, does a doctor? It almost doesn't exist. And so for some people that come in, they are expecting to haggle with price, and they just quite don't understand. This isn't the instance where that's really appropriate, is to go for the lowest fees, and I'm going to explain why that's important. And the reason is because I want to differentiate between this thing I call true cost and true fees. In our view, or in my view, even before we go to John, the most important thing to understand about investing in the bottom line is it's a profit center. It shouldn't be a cost center. All that matters is your net returns, the money you keep after everything is paid in the end, right? So for example, if you bought just a mutual fund, say last year, and it made 4%, and it's a stock mutual fund, but the S&P, which nowadays costs $0 essentially, it costs $0 to own 500 stocks, made 16%. What was the true cost of owning that mutual fund that year? It was about 8%, right? It was that lost dollar amount that wasn't achieved. And I think that is sometimes missed in a lot of the public, is they don't understand what it is they didn't have at the end of the day. The other thing that's happening, not just with low fees, is this concept of robo-advisors. So in order to squeeze out more and more profit from every account that these companies have, they want to remove all the human beings involved. If they remove salaries, if they remove healthcare benefits, that's more for their bottom line. So there's these things that they're pushing really hard right now called robo-advisors. It's essentially an autopilot for your portfolio, or that's how they sell them. And I hope you noticed the Tesla that was on the side of the road in the first slide. That's the very first autopilot car. And if you don't pay attention to something that's as critical as your retirement account, something bad may happen. So this is a video on the risks of automation. Oh, I just broke that thing. Let's see if this will connect. And this had some sound, but I just stopped. This was a plane testing autopilot, and the pilot was asleep. So no one was there minding the entire company. So, most planes land with autopilot, but those people are normally awake. So with these robo-advisors, this is what they're basically telling you to do with your account, is to attach it to, somebody that's asleep. And, from day to day it might work, but it's that critical times where you need it to function, absolutely, that's going to be key. So let's see if we go forward. So, fees are not something that I shy away from, or we shy away from, because we're very transparent about it. So I just wanted to kind of give you the lay of the land so that you can understand why, JCN's fees are the way they are. In a mutual fund, there's a lot of different fees, and these are really antiquated vehicles to invest. I mean, they were invented in the mid-'60s, back when, there really wasn't too many vehicles to invest within. It was a way for people to pool their money together. Now, these companies spend a lot of money on legal departments to put together these documents. I don't know if you've ever seen a mutual fund prospectus. It's basically 50 or 60 pages long, and it's really hard to read. Like when I had to do some analysis on these, it would take quite a while to try to understand what was going on. And so what they do to kind of, I don't want to say trick you, but to obfuscate what their true fees are, is they split them up in this document so that they're not all in basically one section. Now, the expense ratio, this is what you see publicly posted. This is what they published in magazines and on their website as the fee. But the way that these legal departments have worded it, they're able to section out or divide out some other things that you might not be aware of. This is from a study that came out in 2011 about fees in mutual funds. And essentially the bottom line is this legal company, law firm, was hired to do some investigation on this, and they basically found that there's quite a bit of costs that are not found even in these documents. So you have to do some forensic analysis to really get at these fees. The average fee they found was 1.2 for U.S. stock funds. The transaction cost within the fund was another 1.4% inside that fund. So that's something you don't see, you don't feel that, because say they didn't have any transaction costs and you had an extra 1.4% that year, it's just not a gain you ever had. So it's hard to see it was there. The other thing that mutual funds have, and ETFs do to some degree, is kind of an embedded tax cost. So say the mutual fund fee bought a stock in January, and then you didn't get invested until June, and then they sold it in July. Well, your portion of that fund ownership has to pay the taxes on the apple that was bought in January, even though you only owned it for a month. So those fees can add up to about 1 to 1.2% on average. And also there's something called cash drag. So in any fund, they have to hold a little bit of cash so that they can do the trading. And so that, over a 10-year horizon, on average was almost 1%. And then there's these other fees that, there's hints. If we see a new client come in and we look at their account, there's hints that they might have been exposed to these fees, but again, they're not something that are in the document, so it's really hard to figure out. Soft dollar is essentially where an advisor is incentivized to sell a specific product, but they might not be paid in cash specifically. It could be given to them in other services and whatnot. The thing we see most often is this thing called breakpoints. And for new clients that come in, sometimes we try to break this to you in the easiest way possible, but essentially a mutual fund is like any other product. They need to sell more and more every year, and they incentivize the salespeople, not the advisors, not the people that manage, to sell more units of these funds. And so a unit is usually $5,000. So the one thing we see quite often with prospective clients is they'll bring their accounts in and they'll own 20 different funds, and every single one of them is a $5,000 allotment. And so in our view, that's not, they weren't harmed in any way. They're diversified, which I'm going to explain a little bit more in a few slides. But somebody basically took the advantage of this opportunity to hit their sales goals. And so that's sort of the first thing we notice if we see an account is if they own 10 different funds and they're all in the same family, meaning they're all from Lipper or Morningstar, or even if they own all large caps, so somebody made a little change there. And so, again, it's not to bash mutual funds or other advisors, but this is a very common practice that, still happens today. So, bottom line with this, if you look at all the average fees in this study, essentially if you have a non-taxable account, the total cost is about 3.5%. In a taxable account, it's actually more. I didn't add the total cost there, but that's really the average price of being invested on a yearly basis. And so when we go over, how JCN's fees are, it's going to be very clear why we operate in such a different sense. Now, the second part of this set the record straight is in terms of cost. So we know what fees are. We know that's basically the cost of ownership. But in our view, that's not the true cost. So if you took the top 20 most popular funds that are owned in retirement accounts, I just pulled these from the internet a few days ago. So these are the 20 most widely held mutual funds, and you think you're diversified. Well, if you have a 2008 bear market or even a more shallow bear market, did that really help you to be diversified in that sense? No, it did a little bit better than owning just the S&P, which again costs nothing to own nowadays. But your cost was 50% drawdown, which at the time everybody thought it was going to keep going down, so it was a scary moment. But it was also 5 years of no gain. So that's really, when you focus on the cost of investment, or if you focus on just the fees involved, it's sort of not taking into perspective the true cost. The cost of no risk management, basically not being in the market, could be pretty heavy sometimes. What about to the upside? So again, I just compared the same group to a zero cost S&P. And you can see if you bought the exact low in 2009 and you held till today, these 20 most widely held funds, which are managed by advisors, were significantly underperformed just being in the S&P. So that's why you hear from us a lot of the time that index funds and S&P should be basically the default position of any beginning investor. You would actually had about $38,000 more by not going into these other funds. And so that's something that we're going to talk about in a few slides, the cost of over-diversification. So, this is taken from, I tried to get the most recent study, and the most recent one we can find was in 2016, where it was verified, and it basically was a Forbes and a Lipper study. But essentially, if you look at every single piece of what a lot of the industry uses to invest, the fees are 1% is your average advisor fee. The fund expense, like we showed before, is about 1%, and then these other hidden costs that no one is aware of. You factor that all in, you're looking at a 5.5%, anchor that you got to drag every year before you make a single dollar. So it's always funny to me, and I think it's just because people are unaware when we get some pushback on how JCN charges fees, because we're a completely transparent fiduciary, meaning it's all in our fee, meaning you have no transaction costs, no cash drag, no tax drag, because everybody's accounts are separate. And all those costs of running the fund are within the wrap. Anything else to?
Well, it's just a matter of knowing. We're going to say it a little longer, but a mutual fund today is not managing money. If you've got $4 billion in a fund, how can you manage it? How can you move? If we manage a $5 billion fund today and we know the market's going to crash tomorrow, how do we unload? We don't. But we don't want to lose our customers either. We don't have clients or customers, so we tell them, hold on, it's going to come back, and you're diversified. And we say, well, that's what I'm going to do, and I'll be okay, and you probably will. But we do quite a bit of analysis of funds when people come in their portfolios, and it's amazing. I can't remember I haven't had a time where a portfolio of mutual funds did better than the index. So, if you're going to buy a mutual fund, buy an ETF instead and buy an index fund. But the way that they're sold is through the fund cost is your expense ratio, and people think that's their only cost. So it's important to understand that part of it, plus the cost of being diversified, which we'll talk about here in just a moment's time. I don't want to get ahead of myself.
Yeah. Excuse me. Is there a time that you would go into cash?
Great question. We've done that last year, remember?
Yeah, I thought so.
Yeah, we do. But we have the advantage because we're small enough to do that. So it's not that these big firms don't see the value in getting out of the way. Take Warren Buffett. He may see the value in getting out of the way, but he can't. He's got too much, because when you have a stock to sell in the market, what can you sell without a buyer? So the market's in a tough way. The buyers just aren't there. So we're able to do some things big firms can't do. We've got about $100 million under management, which sounds like a lot, but in the grand scheme of things, it's just a drop in the bucket. I mean, we'll go to cash probably once every 3 to 5 years. It's not a real often thing, and we're going to show, when we show the model a while longer, we call it the ejection handle. When we get the signal it's time to be out, we'll be completely out.
So that's it for fees. Sometimes I think it's a little tough for people to talk on that subject, but for us, we are very proud of that structure because it's a huge advantage to you guys. We're not limited by handcuffing ourselves with transaction costs, so we could go to cash all tomorrow and then the next day go right back in if we needed to. Not that would happen, but those are types of things that a traditional investment vehicle or traditional zero-cost broker is going to limit you. For example, right now they advertise zero-cost trading at Charles Schwab. Well, there's tiny little print that says you can't sell for 6 months. So, okay, zero cost to trade, but then what if everything goes down 50%? What was my cost?
And it's very important to note that, our fee is lower than the average mutual fund, but it's not that we're doing less work. We have less overhead. These funds, I've got a guy come in just yesterday. Every fund he had was with American funds. Now, is it reasonable to think the American fund, of all the funds out there, every class they've got the best one there is? Probably not. But these fund companies will pay money to you to sell their funds and pay endorsements and so forth. So that adds some fluff to it. We don't have any of that. But the average client of mine, when they come brand new, don't realize we are less than average mutual fund by far, because we're doing the advisory work and the investment work. But that's not where your biggest cost is, period. Your fee is not your biggest cost. Anybody that's got a portfolio of mutual funds that are other than index funds, their biggest cost is performance. And they don't know. They think they're doing the right thing by being diversified, but they're not really diversified. If you look at your fund, if you have more than 30 stocks, you're going to do about what the market does. Well, the average mutual fund has 150 holdings, and guess what? You can find Dodge & Cox, American Growth Fund have a lot of the same doggone stocks. So you've got different holdings, but more of the same thing.
So just a quick refresher for some people who haven't seen this, because we did this last year. Here, you can ask a question.
I'm sorry. I just had in the fees area and everything like that. I think I understand what you're talking about on the ETFs versus what we've got here. But where does TD Ameritrade come into this? There's a lot of stuff that they're doing for the global us.
Yeah, they are. They do a lot.
And everything like that. I know companies like that aren't going to do it just because they're nice people.
I pay them.
Excuse me?
I pay them
You pay them.
a lot of money.
Okay. That comes out of the fee that is already noted in there. There's not a hidden fee from TD that they just keep it under the table.
Absolutely.
They bill me every quarter, but all the trading I pay for myself.
Okay.
Yeah, you'll see on the statement, the only invoice you ever get is from us, and there's never a fee essentially from.
It's
It's
sort of like the ETFs. You don't see a lot of those fees that you show.
because it's inside the shell, right?
Because it's somewhat hidden.
Right.
In that 60-page document. You don't really see it on any bill that you get from them or anything like that. And I'm
Right.
just wondering how TD fit in all of
No, they don't bill our clients.
Yeah, they don't build. That's a good question, though. I appreciate the asking that.
Yeah, talking about the fee you pay, didn't you, as I understand what you told us earlier, you paid like a flat fee for unlimited transactions.
Well, just on the business side of it, you can do, well, for JCN, I have the option of paying TD per trade, or I can pay a higher fee and get unlimited trading. And so when I had to make the choice, I decided to pay more money to get unlimited trading because I didn't ever want to be in a position where I felt it to trade your account. So I didn't ever want to get in a position where, gee, we really ought to trade, but you know what? This is 1,000 trades. It costs us this much money. Maybe we could hold it a little longer. So I'd just rather pay for it up front and be done with. That's a personal, just the way I do business and the way I operate.
So in this section, I want to do a little bit of quick refresher because the first part of this we didn't do till basically last year. And so this will get some of you new clients and prospective clients up to speed with kind of how we operate. So first, just an example of how we actually buy stocks. Now when Chris comes, he's going to go really into detail on this, but I want to just give a broad overview of how this operates. Imagine you were looking on Zillow and you wanted to buy a house. And you saw one listed for $1 million, and you saw another one listed for $1 million. Okay, and they look both pretty good. Well, you go to appraise them before you bought them, and this is what the appraisal came back for. This is what the third-party company said is the worth of this house. This one's only worth $760,000, and this one's worth $1.2. Which one do you think is a better deal? Right. That is the most common sense example of how we buy stocks today. We appraise the value of these companies, which are represented by the stock price, and we always search for a deal in the market. And we essentially stay away from houses that or stocks that are overvalued. Now, how does the appraisal work? Well, just like Zillow, we use it's called a machine learning algorithm, and it's kind of a fancy word for training a computer to think. And so it uses all the things that say go into a house's price. So you got your city, neighborhood, rental income, how many bedrooms, bathrooms, all those things make up the value of a house. So for a company, it's profits, sales, what industry it's in, what sub-industry, what country, what the inflation is for the whole country. It's a lot of the DNA that goes into those companies that we use. How does our specific strategy work? Well, we hunt in basically the biggest 2,000 companies. We're a little bit wider than the S&P 500 because when companies get so big, they just have a hard time growing quicker when they get to be such a huge size. So we hunt a little bit down into the mid-cap section of the market. And some of the minimum things we look for is a company has to have 3 years of steady profits. They have to be proving to us that they're making money, not just 1 month, 1 quarter, 1 year. They actually have to be basically on a roll. So if you notice, we don't own any energy companies right now, and I will explain why in future slides, but this is basically the bottom line. We're looking for profitable companies to own. In addition to that, we're also looking for companies that are 30% under their value. So they're trading for a discount to what their true value is, and we know that from our algorithms. How we make the portfolios is we don't put all our eggs in one basket, but we do like to overweight certain sectors. For example, semiconductors and healthcare right now are doing really well, and we have quite a few of those positions. But more important than how we buy stocks is this concept of risk management, where stop loss and our target are predetermined before we put this in our portfolio. So we know exactly where we're going to get out if it goes down, and we know exactly where we're going to get out when it goes up. This model was designed for risk management. It wasn't necessarily designed for hitting the cover off the ball performance, even though that's what you will get in a good condition market. But it's really how to protect capital when things start going down. Here's an example of one that we just bought recently. This is the value of this company. This is Thor. They make Airstreams. And here's the stock price. And you can see the stock price moves pretty jagged. It's kind of noisy. But the value of the company every single quarter keeps going higher and higher and higher and higher. And so what we look for is when the stock price goes down and the value keeps going up. That means the market has mispriced this company. So we step in, and in this case, it's going up to its fair value.
See, for most people, that's counterintuitive. I see a stock I like is going up, and now it goes down. How many people know no more than the fact that it was going up and it's going down, want to buy it when it's going down? Very few want to. That's why it pays here to know. And we've done very well by knowing. So we didn't just buy it because it went down, but because the price was going up at the same time. We're shopping for better value. The overall market, stock market, is overvalued. So when we're looking for undervalued stocks with the parameters we have, we're shopping in a pretty small store to get there.
Exactly.
John, I do have another question.
Sure.
You mentioned that you had these predetermined targets as to when to get out on the high side and on the low side. And so if something is going up and it's a good company and everything like that, and you're reaching the upper position and everything like that, is there anything in the model to reevaluate that for a new target rather than getting out?
To some degree.
Every week they're appraised. So if the value goes up, we'll stay in it. But if the value is $200 a share and it reaches $200 a share, it's time now to get out and go find something else. So we reappraise the values on every money.
I'm looking at something similar to what you're showing.
Yeah, I'll show you an example. I mean,
Going up,
like-
you had said to get out right at where we're at right now originally. Do you keep evaluating that and saying, well, maybe that's not the price, maybe we ought to put a new target in for like 140 or 150 or something like that?
it is dynamic, but it's not just completely dynamic. So it has some constraints. We know from the modeling that if you hold a position too long and it doesn't really go your way, we sort of have an expectation that it's better off to just find a different position. So there's a lot of information in action and non-action. So say, in this case, Skyworks, we bought around $80-something last year. The value at the time was $140. It's since gone up a little bit, but what's going on here that's hard to show is we have sort of a time limit in our position holding. And instead of just holding something into perpetuity, if it stops moving, if it's dead money, then it actually kind of wants to get it out of the portfolio. It kind of wants to kick it out. And so,
A dynamic piece.
yeah, there is a dynamic.
It's not just an absolute, if I wanted to get out originally when it hit like 60 or 70 or something like that, if everything is looking good, that you can restate what your
Yeah, it does do that to some degree. Yeah. So, in this example, the stop was way down here when we first started, and this is where it is today. So the stop loss is moving up, behind the price. Here's an example of one that I think is potential to be really great, and we owned this a little bit, a very brief time last year, but it's again gotten really cheap. This is Express Scripts. They're America's largest mail and delivery prescription company, and the market is really scared right now that Amazon's going to take over this industry, but it's really unlikely, I think, in the near term. And one of the things that we can see is every single quarter, Express Scripts is making more profits. The value of this company keeps going higher and higher, but the price keeps going down lower and lower. So this is where, we have a huge advantage. We're buying this company essentially at half price, and we're going to hold it until it goes up to its fair value. Now, if something happens and the CEO, punches somebody on a plane, we're going to have our stop loss. But really, this is the kind of thing that we just rinse and repeat over and over again, is trying to buy these undervalued companies.
Are you doing any options or puts when you're doing any of the trades?
No puts, no leverage, just cash position. Options, I used to work for an option market maker in Chicago. They're very, very difficult to trade profitably, even for professionals. So I tell people to be very careful what you do with options, because they're not really designed to benefit anybody but the seller in most cases. So more on risk management, I found these two really interesting studies. I just wanted to kind of explain different ways to think about risk management. What these guys did is they just took the S&P and they said, let's invest for 20 years with $10,000. And let's just imagine, in perfect hindsight, that you just remove 5% of the downside. This is how much more money you made. Not by buying any better stock, but by just not being in the market on 5%. That's one dip. That's one dip in a 20-year period. Now, what if you did it in 10%? You have a huge gain there by not really making any better stock pick or thing of that sort, but really losing less is sort of the key to the game. Now, another thing they did that I thought was interesting is they said, all right, let's invest in the S&P, but let's just, in perfect hindsight, remove the 25 worst performing stocks. Well, gee, that's a huge difference by just not investing in areas that are underperforming. So for us, this is really telling, because this is actually proving our model to some degree with this particular study. This is the data that comes from Parallax Financial Research, and this database has been around since the early 90s. And so the performance of the stocks in there are what we use to pick our portfolios. And what it shows is, the average return for the market is about 9%. This is if you're in the S&P. And if you were to buy those overvalued companies, or in that previous study's case, bad performing companies, you not only lost money, you underperformed the S&P by basically 10%. So, these are the types of companies we want to stay away from, that they're overvalued and may not have any profits. Now, if you hunt in the undervalued section of the database, and where we pick portfolios is in 30% or more undervalued, this is where over, and this is a few decade period of time, you can get that excess performance by not, or by essentially owning these companies that are undervalued and profitable.
Let me go back to that slide. This is my favorite slide to all we talk about, because this is the best slide, period. This is very commonsensical. If you're a real estate investor, and every house you buy is 30% or more, selling for 30% more or less than its value, do you think your chance of being successful is greater than a guy that's buying a little of everything? And stop to think, yes, certainly. If you're buying houses for $1 million and they're paying $700,000 for them, and you buy one, you pay $1 million for it, you have a hard time winning. You think about the average, if you look at your mutual funds, they don't know what they have in there. They don't know what the value is. They don't look at the value. I found out this chart here a couple of years ago. Chris Kaufman and I were in Idaho with Alex, and he was telling me about this price wizard he developed for a Wall Street firm. He said, John, they were bringing stocks to the market, and they didn't feel like they were charging enough for the stocks they were bringing to the market. So they paid my firm to develop a wizard to calculate the true value of their stocks. It took me 10 months to develop it. I delivered it to them, and they used it for less than 2 months. And I said, well, why is that? It wasn't working? No, it worked. But when it appraised their stocks, they weren't worth as much as they were already selling them for. The people selling you this stuff aren't concerned on the value. And again, with the mutual fund, they're going to go away eventually, because they have a lot of trash in there. They're so big, so monolithic, and the public doesn't know what they ask for. And quite frankly, if they wanted to do this, they couldn't. Why couldn't a mutual fund, why couldn't Vanguard do this? Why couldn't they say, your portfolio is going to have nothing with stocks that are 30% or more undervalued? There's not enough. There's just not enough. So if we run the firm, we got to be in business. That's not going to be our strategy, right? There's just not enough.
Yeah, absolutely. So this is a concept we want to kind of spend a little bit of time on, is this myth of diversification that we talked about last Speakers Bureau. But if you go to business school and you take, some higher end investment classes, they talk about this thing of mathematical risk. And so the risk of owning 30 stocks, just 30, is actually exactly the same as owning 500 or 1,000 or 10,000. It's mathematically exactly the same. And if you own more than 30 stocks or 50 stocks or 100, it makes it really difficult, almost impossible, to ever do better than the entire market itself. And so that's one of the things we try to do here, is try to get a little more juice out of the lemon, but it's just not possible by owning a lot of positions. So, the reason why we really limit and we concentrate our investment focus is to try to get this, risk exposure the best we can. We're going to skip this because the video didn't work, but I wanted to show just an example. This is a video that's online, and it's from Fidelity, and this is what they tell you to do. Essentially, they give you the standard, don't put all your eggs in every basket, and if you're diversified, it will help on the drawdowns, right? Well, the fact is,
So diversification is a very interesting topic for me, because I've been in this business long enough to where I've learned more about that. And I think I've got a way to help you understand what it means. How many have ever played roulette? Am I the only one? Okay, it's where you have the wheel spinning. It's black or red, even or odd numbers, and you pick where you think it's going to go. So when you do that, you're gambling, right? So if you diversify your picks and say, you know what, I'm going to go on the red ones and the even ones, you've done some diversification, right? But what if you knew it was going to be a black one? It was going to be a black one, and it's going to be between 0 and 15. How much better a gambler would you be? So I can get, without any knowledge, I can place them. I've got some indication where it's going. Most of you feel like you're gambling because you are. You don't know. And then you listen to the things you hear over and over and over that make so much sense. That's going to make me money. That's going to keep me safe. From the very same people that are selling you night and day. The wealthiest investor in the world, click it, one more slide. That doesn't work, Will. The wealthiest investor in the world is Warren Buffett. And you'll see that he says that wide diversification is only required when investors do not understand what they are doing. In his quote, he says, hey, diversification is terrible unless you're ignorant. He goes, I would never diversify because I'm not going to do as well through diversification. Charlie Munger, his partner, he's a billionaire. You know how many stocks he owns? 3 stocks. But he knows what he owns. You take a look at diversification is the most destructive, overrated concept in our business. Look at George Soros, Carl Icahn, Warren Buffett. What do they have in common? They make huge concentrated investments. You need ruthless discipline. If the reason you invested changes, get the heck out of the market, move on. Bill Ackerman, diversification covers up ignorance. So I think it's a very egregious way to invest is with not knowing. And so these algorithms we have, the way we do this, puts us in a position where we don't know everything, but we know enough to be able to get a better rate of return. And so right now, I have people come into my office today. If you have a mutual fund today, you know what it owns? Somewhere in that mutual fund, you have energy. And you might say, gee, energy's so down, it's going to come up. I agree, it probably will. But when? Next.
So, what Fidelity tells you to do is buy a little bit of everything, but I love just proving it wrong with math. I just pulled the double-digit declines in the S&P since the 1980s, and you can notice European stocks, small stocks, emerging market, and even other mid-cap stocks, they'll go down together. There's no diversification. So the fact they haven't updated the textbooks at these business schools is always funny to me, because how many decades need to go by before this needs to be acknowledged? So what does that mean? That's really why our model's designed the way it is, because we believe you don't have to be through these downtimes. You can sit in cash. That's not, a bad option.
This is mine here. I love this, okay? Because I had a guy just this week in here, okay? So energy this year, this is the returns. The S&P has made 13. Valero's made 9, Phillips 7, Chevron 1, Exxon lost 9, Hess lost 29, and Rig lost 30%. That's the energy sector. So let's diversify within that. We're just not in it. Now, semiconductors, S&P's up 13, 84%, Lam Research 72. We own all these too, don't we? Yeah, we own Lam, Micron. Anyway, so see the difference in returns here? Just knowing where to hunt, rather than say some gross diversification. But again, if we ran a $4 billion fund, we can't do what we're doing here. We can't. Well, there's not enough inventory to do it. We're going to put together portfolios and lose a lot of money on marketing and selling. The reason I wanted to bring the fee thing out is the only thing they have to publish is their expense ratio. So the consumer is not knowing any better, look at that and say that's where it is. So you may end up having a higher fee than you think and a much higher cost. We had a guy just this week came in. He's been slaughtered being in a wildly diversified set of American funds.
Absolutely. So we're going to just cover our two portions of risk management. I know a lot of you have seen this, but I just wanted to go quickly, briefly how this operates. We have two mechanisms that get us out of the market, that take us to cash position. One is likened to an eject handle. It's something we only pull in an emergency situation, and we don't imagine pulling it all that often, and then we put a seatbelt on every single stock position. Now, why do we do this? Because the market goes down. It's gone down for 100 years, and it goes down quite a bit. So people that believe that buy and hold is the only way to invest, I take huge opposition with. So the risk management, the reason why it's so important is because not only prevents lost capital, it prevents lost time. And we see some prospective clients come in and tell us the same story where the market went down and they got scared and they went to treasury bonds. Well, they kind of shot themselves in the foot because they didn't allow their account to rebound. They basically sat in a zero income investment and they lost about decades worth of time getting back to even. Now, this is something we found just the other day, and it was actually kind of interesting, where, if you lose 10%, you have to make 11 to get back to your initial amount. But then you're not factoring in if you're taking money out of the account. So say you're pulling off 5% annually, over a 5-year period, you actually have to make 44% to get back to your original amount if you have a 10% loss. So this concept of these drawdowns, these losses in the account, get even more exacerbated when you're actually living off of the account. So it's really critical to understand why risk management is so important at this stage in everybody's investment cycle. Now, one of the models we use uses a tremendous amount of economic data. It uses initial claims. It uses basically 100 different factors about the economy. And so we know what the economy is doing basically at the end of every week. Is it getting better? Is it getting worse? And one example I love to show that's really easy for people to understand. This is industrial production. That's essentially, do we make more things today than we did yesterday? And when we stop growing, when the economy starts, contracting, this is when it goes red. And essentially, if you just not be invested during those periods, the difference in gain is staggering. And that's not by picking better stocks, that's by sitting in cash, that's by being in a safe position and waiting and being patient. So this is something that we're trying to communicate to our clients is what's the cost of being in the market when it goes down. Sometimes it can be pretty big. This is 30% loss, this is a 50% loss. So this is something that we're going to talk about more and more in the future as it comes forward. But essentially, earnings are the biggest driver of the economy. And right now, earnings are the best they've been in maybe 10 years. So, you might see some fear-mongering in the media. The market's too high. It's gone so far. There's really no premise to that. The reason stock prices go up is these companies are making more profits. So, right now, that's what's happening.
When you go into cash to hold it during a downturn, does it still make a little interest?
Yeah, so we don't actually just go exactly to cash. We go to short-term treasury bonds, which is a cash equivalent. And in certain cases, like in 2015, we use a little bit of preferred stock. And so what that does is it has like a 5% income. So we'll get something from it. We'll have a little bit more at the end of the year, but it won't be, a loser basically sitting in cash. So some of these I'm going to skip forward through because they're a little bit excess. But, for those of you who don't understand how the seatbelt works, this is where we bought Apple, 106. The stop loss was at 87. And then as the price rises, the stop loss goes up behind it. And how that looks is like this. This is a price chart of Apple. We bought it right here. And this is where we're going to get out. We're going to say, all right, that's enough for this position. And then it follows price up, and it's now somewhere up around 130 something. So that's our safety net. That's our biggest position, is the ability to be in cash. Now, what is a portfolio going to look like over time? Well, when we have stocks to buy, we want to be in this position where we have companies to own, they're undervalued. This is where we're going to make the most gains. If we get to a point where the market gets to be fair value, but we don't have the exit signal, we're actually just going to go sit in a dividend index and just get paid dividends as long as we can, unless things get better or if they get worse. And then if we get the signal to go to cash, we just sit in cash. So that's how everybody's account will exist, and they'll all mirror each other. They'll all always either be fully invested, partially invested, or completely in cash. And so that's the positions we have. Here's some examples from this year I wanted to point out. This is a company that looked really great, MedX. They own prenatal healthcare companies around the nation. Here's the value of the company. You can see it's going pretty good for MedX. And our model decided to buy, I think, around $62. Now remember, we have the stop loss. Something happened and they reported bad news, and we got out right around 64 something, and we sidestepped basically $20 of downside. See, that's the risk that, there's no way to know. And at the time, it was a great investment, but you have to have risk control. You could see it would have been a really tough thing to ride that loss all the way down. Here's a couple other examples. Yes?
Did you net a total?
This was a loss.
So your net was negative?
This one was a negative. It literally went.
Bought lower.
We
made
bought
money, but then when it came down, the net was a loss, is what you.
Yeah, we bought around 62 something here, and we sold it at 58 something. So we lost $4, I think. It was a manageable loss, but it was way better than a $20 loss. Here's
a good time to buy now.
Well, here's the problem. The numbers are bad. So you see how they're going down now?
Yeah.
So this company no longer is in our shopping list because their earnings are going down. So you'll see this.
Do you usually know why a big jump?
It's profits, yeah. It's bad profits. This case, they acquired a company.
What does that mean?
They lost money, or they made less money than last year. They made.
But it looks like there was some incident.
Well, in this case, what happened is they acquired another company, and so their worth actually went down a lot more. So that this distance that the price moved was the actual value of the company they acquired. So that's an unfortunate, instance, but it happens from time to time.
We don't try to subjugate why something's happening or going
Right.
to happen. We look simply at the math of it. Because
Right.
when you start trying to, you can say, well, if two cars run into each other head on at 70 miles an hour, everybody should die. But they may run together and not die, right? So we want to go less on what we feel or think, and more just what do you feel sticking in our fingers?
So, this was an example of a semiconductor company. It was in that sector that is really hot right now. And they make the camera that goes in GoPro. And so we bought right here, went down a little bit, and it started going up towards its value. And then it actually stopped us out basically almost where we bought it. And so, in some of these cases, the risk control is going to be tighter than other ones just because the values are different. But these are trades that actually happened this year. This is one that was kind of tough. We really liked owning this position. This was Prudential. They're not a casualty insurance company. And we bought it down here, and we rode it up during the Trump bump. And when Irma and what was the other one? Harvey came into town, all the insurance companies started to nosedive. Doesn't matter. These do life insurance, so it has nothing to do with the casualty side. But you could see this was our stop loss that came up, and we just got stopped out right there. So it's recovered, but in this case, it's better safe than sorry. Say there was, you know, a 10-mile difference in how that hurricane's path was, you know, it could have taken down the whole
Are
company.
you adjusting your stop loss, or do you have a model that says 25% and we're out?
It's a little more complicated than percent, but it's automatically adjusted and emailed to me and John every day. So we can show you that on our risk dashboard. Here's an example of Skyworks. You know, here's the stop moving up. It's 100% automatic. I don't decide where it is. It's designed. Yeah, it's
Have anything in it that you get out because you hit a stop loss, that you treat getting back in to that company later on differently than if you got out because you hit the upper limit?
Yeah, that's something that happens a little bit. If we stop out, we have what's called a lockout period. We're not allowed to invest in that company for 6 months. And then if it's still good, we actually might go back into it. We actually did that with a few companies now, FedEx, and one we actually put on today was Gilead Sciences. It's a very undervalued company, and we got stopped out at the election when healthcare got dumped, and then now it's, you know, still very undervalued, so we put it back in the model.
Okay, so repeat that. So if you get stopped, if you are out, you can't buy back in for 6 months.
6 months, yeah.
Is that law or just something you said?
That's just what the model found to be the most ideal, because in MedAx's case, you know, it dumped for acquiring this company, and that new information needed to like soak into the value, right? People needed to kind of get rid of it, and so it's not anything that was kind of predetermined. It's just basically it's enough time where, you know, it might be a better instance to get into that company if it starts going up.
Rules about getting out on the high side. If you make all the profit that you thought, and you got out because you hit the upper number, you had the same 6 months.
Yeah.
You can't deal with it.
Mm-hmm.
Really?
Yeah. FedEx is a good example. We owned it in summer of last year. We rode it to the end of the year. It was locked out, and then we bought it basically 6 months later this summer, and we own it again going into the end of the year.
What's the reasons for that?
Chris can answer that. He does all the modeling. But essentially, when you run thousands of simulations of portfolios, the data is much more clear than just one single instance. So when we build these models, we look at not just one period of time. We look at basically thousands of simulated years, and we say, all right, you know, instead of just living one 10-year period and saying I have 10 years of experience, a computer model can live 5,000 times through the future and say, all right, you know, 3,000 out of the 2,000 times, this was the best way to behave. So that we have a huge advantage with this modeling, and it's not unlike driverless cars, like I mentioned. You know, a driverless car, you know, in their infancy now, but what they do is they have all the trackers in your phone, and they drive around the city 10,000 times, you know, in a week, and then all of a sudden a car knows how to drive around the city. So this is trained in a very similar instance. And you know, it's much more thorough than saying, you know, in this one case, you know, why does this work? Yeah.
Does the target value change as the valuation of the company changes?
Mm-hmm.
So the target and the stop can both move?
Oh yeah, it's dynamic. It is dynamic. You can see every month this changes a bit. Now it's somewhat constrained, meaning, you know, if it doesn't have an unlimited limit to where it can go. Like it's just very unlikely a stock goes, a large cap company goes like 200% up in a year. So in our modeling, it's just proven that if you take something at a 50% gain, you know what I mean, you're getting most of the potential gain than you were to like hope it keeps going higher. Yeah, those really high flying stocks that everybody gets in the news that thinks are amazing, that only happens once out of 10,000 stocks. So we don't want to bank on that in any way. Here's one we have that's going, this was the value when we bought it way down here, I think. And the new value is way up here. It's off the screen. So, Lamb Research powered through the point where we were supposed to sell, and we sold a little bit because it had such a big gain, but we're keeping it on because how good the valuations are. It jumped so high. So it's basically all been reset at some degree to a much higher price. And so this is just a case of why, having these concentrated positions are going to be really good for us over time, because you get 3 or 4 60, 80% winning trades. It not only covers any of the small losses we had, but it gets us way above the market. So John, you can talk about where we are with the model. Okay, well that's
How many stocks would you say you're invested in?
between 25 and 30 total. Sometimes more, sometimes less. It kind of just depends on conditions, volatility. So say you have a really volatile.
Clients' needs?
No. These are portfolios. So we have 6 different portfolios. And it's going to match the client's particular needs that is going to how you choose that portfolio. But the stock picking, and that's a good question, because I think if you have some based on how the client feels or thinks, you're bringing emotion into that. So we have a very disciplined way of investing the dollars. And now you choose, or we choose, which model is going to best suit your needs. Ideally, we had 20 stocks, we'd make more money. I know we would make more money, but we've got a portfolio design to mimic volatility, minimize volatility. And that's why we don't hold 20 stocks, 15 stocks. But we hold 25 to 30. And anytime we sell one, we send you an email telling you what we sold. TD Ameritrade sends you confirmation what was sold. But what we do is really about as scientific as you can get. It's just in a non-emotional way of going about it. And I think that you're going to find the results speak for themselves. This is going back for this year, I think, year to date, through September 30th. And our stock strategy made 16.75%, which is 20% more than 13.8. So we outperformed by 20%. That's remarkable. When you consider that 95% of funds don't do as well as the market. Now that's just going to show for this year. And if you show since inception, clear one more time? Is it 30%?
Yes.
So, but then we're 30% more greater than the market since April of last year. And it just goes true to saying that you have a smaller set of stocks, buying stocks that are undervalued and not holding it forever is going to mean easier path for each one of you, because right now the market goes down 40% between now and next year, now next June. Alex and I would say that's the best thing for us right now. And the way I say that is we're going to get out. We might get down losing 5 or 10%, but if you have $1 million and you lose 10%, now you have 900,000. But when it ramps back up, we're going to get 80, 90% of that and just tear it up with returns. So I do expect we're going to have the market's eventually going to run out of steam. That's the type of thing that happens. And you'll see it in your portfolio. You'll have less stocks. We'll have more of probably an ETF of the S&P 500. And we'll be telling you in our emails and letters, what's going on with that. We can't, there's some anomalies you can't defend against. You look what happened to Equifax. I mean, with that breach like that, you couldn't, but we still had a stop in place that gave us some protection. But at the end of the day, the secret to making money is not to lose it. And if you want to do better, you got to be smarter. If we're going to do a better job for you, we have to be smarter than the next guy. And we can't afford to be lazy. Most people in this industry are very lazy. I know this, I coached them around the country. I quit doing it a couple of years ago, but they were very lazy people. They didn't want to learn enough, to know enough to really help their client, because all they really had to know was this much more than their client to be considered an expert, right? And so the reason with these workshops today, what you should have learned is, or should have reinforced, was the fact that, hey, the market's real bad, we're not going to be in it. And that every stock you have has a seatbelt on it. So it can go down, but to a certain degree, that's it. And that's going to give you a better push to go, going forward. this is going to be next month's going to be a real important speakers bureau because Chris will be here talking from the technical aspect of how we put together these algorithms. And if you make that one, I think you can ask some questions that you'll get a lot of, get the answer to your question that'll be very, very beneficial to you.
And are you managing mostly retirement money or just investments?
The majority of the money we are managing is qualified money, retirement money, probably 75% of it? 75%. Most of the money in the country is in a retirement plan.
So the trades, I'm just thinking about the tax consequences of trading in and out or something.
Yeah, so it can go for or against you. I know last year the average client had gains and they wrote it off, or had a write-off. This year you may have a tax, but a guy was in just yesterday was in our office and said, well, you've made 30% more than the market made, and if you pay this much tax in it, you're still 20% ahead. So you got to be real. We're tax sensitive. It's a big part of my business, but you don't want to be penny wise and pound foolish.
Right, if you prevent a sale to bypass the tax, but the stock market goes down 40%,
Oh, I understand.
what was the cost? That is something that I kind of want to do.
But if you have mutual funds, obviously they have high turnover ratios. That's why I was wondering if you had high turnover.
Well, you're not going to be like a mutual fund that they're going to be your position. So if you come in mid part of the year, you're only going to be taxed on your funds. Whereas a mutual fund, you come in June, you're going to pay the tax for somebody back in the first part of the year.
John, having just opened an account with you guys a few months back, I retired March 1st. I have money with 3 different managers, including John. John is more than doubling for one of the major companies, more than doubling. He's doing 25% so more than the other. One comment back to Warren Buffett. If you go back 25 years ago, Warren Buffett, when not long ago, he started in the 50s. Back into the 50s and the 60s, he was doing 25% plus annual. He's doing about 9-10% annual now, simply because he is so large.
Right.
He starts buying anything, the price goes up. He starts selling anything, the price goes down. This is why the mutual funds can't beat the S&P. Because they are so large, they move the market every time they try to trade, and they can't pick stocks to find that kind of growth potential in them. So they pick a broad spectrum of stocks. I don't know why in the world you put money in a mutual fund. I don't.
I know why, because you don't know any better.
No.
It all makes common sense. It goes on the preposition that you just don't know. If you don't know, you buy a little of everything. But if you know, you're choosy. And so I can tell you the biggest single investment I have is in research in this office. I spend far more money with Parallax for their research than any other single person I spend money with. But it's the best investment I've got. I mean, you're a testament to that yourself. So it's changed my view of money as well. You know, how I invest money, how to recommend it. 10 years ago, for the average client, I'd recommend a much more conservative portfolio than I would recommend today because I didn't have any control going forward, and I was concerned and afraid that we could have a bad market that would take the wheels off the cart. So I would say let's go to a very, very conservative portfolio because that way I know we're not going to have the same carnage in a bad market. At the same time, I know we're not going to really make very much money either. So there's just a value in knowing, and hopefully as you come to these workshops, you leave every time learning something you didn't know before you got here.
Well, there's plenty of the companies out there that are not beating that 4.85% up there that you're beating the S&P by.
Well, we're aware. I know.
We're very proud of you.
Yes. Well, I just don't want to really emphasize that as much as the defense because that's really what's going to make us some money is being defensive. I think that.
That don't seem like a lot of money, 4.85%. But when you compound on top of that over years, that's huge.
Yeah, that's 30% more return. 23 is 30% more. That's a big difference.
You compound that
Yeah.
every year.
Yeah, it's parabolic. It really is. So we've got some really good topics for the first part next year. Is we also some other alternatives and ways to minimize the taxes on qualified plans. So I'll probably do that in January or February. I imagine in January we'll do our regular speakers bureau. In February I'll bring another tax presentation in. That's something I've been working on for a while. That's very beneficial. So we have plenty of victuals, I think, to hear now, I hope. And so take time to get something to eat, something to drink.